All right. Hello, everyone. Welcome. On this episode of What's the Deal, the real estate podcast that gives answers, we'll be covering what's the deal with hard money lending. One of the most common finance tools in fix and flip and buy and hold real estate is hard money. And joining me today to lend some knowledge on hard money lending is my friend and colleague, Brandon Moulton.
Thanks, Fernando. Excited to be here. Was that pun intentional?
It was intentional.
Love it. So yeah, excited to be here. Crazy times. Election is hanging in the balance right now as we speak on the 4th here, but excited to talk deals.
Cool. So to start it off, why don't you tell the people watching, who are you and what do you do?
My name is Brandon Moulton, Senior Vice President of Lending here at Renovo Financial. What I do is I work with residential real estate investors to help them execute on their business plan, whether it's flips or buy and holds. And then the asset classes we focus on are anything from a single family up to a 50-unit apartment building and everything in between.
Awesome. Okay, so you said that you guys help people out both on the buy and hold side and on the fix and flip side. Can you go into that? Explain to people maybe that might not know what hard money is. What is hard money and how is it different from other, say, traditional financing sources?
Sure. So hard money is really just private money for the purposes of the acquisition of real estate. It tends to be more focused on the asset, and there's more of an understanding, we'll say, that comes along with each borrower and each project that maybe doesn't fit into the box that the traditional outlets like conventional lenders would like to see. So, and then typically it's short term, usually 9 to 18 months is the term that you're looking to turn the money in and either refi it or sell the property.
Okay. And during that 9 to 18 months, is it amortized? Is it interest only? Typically
interest only, but that can depend on each deal and what you cut with that group. Some guys like to see pay downs after some period of time, but typically interest only.
Okay. You said that hard money is usually utilized more when conventional financing sources aren't viable. What are some of those? Give me one or two situations where using hard money would be preferred over, say, using a bank.
Sure. So, from a hard money perspective, it's typically an asset that is in some state of disrepair. Meaning it needs to be turned around, value add, whether it's rezoning or just construction. You want to gut out the building. Banks are, and conventional outlets are lukewarm on it, especially depending on the size of the dollars. They all love the million plus. That's what gets them out of bed. But for those dollar amounts less than $1 million, it's a lot of work. It's not something they really gravitate towards. They want the deal with the bow on it at the end when it's stabilized. But the heavy lifting within the construction period is something that can be a little bit challenging within the conventional world.
Yeah. Now with hard money, you said that it's more of an asset-based loan. When you say it's an asset-based loan, what does that mean, and as opposed to what?
So asset-based meaning looking at the collateral. The focus is initially on the project plan, and then I would say there's some understanding around the personal background, and maybe there's some bumps in credit in the past, but really the focus is on the actual hard asset.
Gotcha. Okay. Now, so you said that you're the Senior Vice President of Lending at Renovo. What does a day in your life look like? What are you doing on a day-to-day basis? Maybe it changes a lot. Why don't you give us a little bit of detail into that?
You make it sound so grand. It just means I have more phone calls than text messages. But it's a lot of conversations, kind of like what we're discussing now in terms of how the loan works, what the cost is, loan to value. But that's kind of the initial onboarding conversations, and then once we've got a history, it starts to become more about what your business plan is and how we can go to the next level, right? Mm-hmm. And then also how we can potentially leverage my network of other professionals to help you get there.
Gotcha. So it's a lot of business development. You're talking to investors day in, day out. Maybe it's helping them source contractors, attorneys, wholesalers. I know you've connected us with a lot of your clients in the past, and we've been able to help them out with sourcing properties as well. When it came to Renovo, give us kind of your history. How did you get there? How long have you been there?
So I initially started my career in finance with a local bank, doing underwriting for construction deals and different real estate opportunities. I did that for about 7 years, and then I was doing some light rehabs myself and got my broker's license and really kind of saw this as maybe a potential path that I wanted to go on as a developer. But I was introduced to the guys here at Renovo, and really haven't looked back since. Started as a loan officer and kind of worked my way up the totem pole here. So, but yeah, I mean, it's been a great run. The economy has been phenomenal, and then there's also just been a more confidence in the idea of private money or hard money lending here recently.
Yeah. One of the things that I've noticed is you guys are very quick to close deals. I've heard from multiple of my buyers that when they use you guys can usually close in, usually 14 to 21 days. In some cases, you've done it even faster than that. I'm not saying that every deal is like that, but usually when a borrower has all their information buttoned up, they're ready or in your system, it seems like you guys can close pretty quickly. When should a real estate investor decide to use hard money? One of the reasons I'm alluding to right now is obviously speed. What might be another reason to use hard money?
Yeah, so I would say there's really three primary reasons. One you just touched on, which was speed. Two is dilution of partners. So within private money, we're willing to go higher, advance higher into the capital stack, so that you have to take on less partners. I think we talked to a lot of folks, and it gets pretty old pretty quick when you're the one finding the deal, running around chasing the contractors, and then selling it. And maybe your rich uncle put up all the money, but you split it at half at the end. That kind of gets old after you do it a couple times, given the amount of work and how hard it is to find these projects and then bring them to completion. And then the third, I would say, is real world underwriting. So there's more understanding around kind of maybe some bumps in your credit, or maybe your tax returns, you're self-employed, so it doesn't look as the way a bank would like it. So just having that general understanding and the ability to have the conversation, I think, is a big driver of why folks like to use private money.
Yeah, I know when we were flipping properties, one of the things that was always tough, especially in the beginning, was when we went to a local bank, they wanted 25 to 35% down of the purchase price. And then anywhere from 50% or more of the rehab we had to fund ourselves. And some banks even quoted me that I had to put all the rehab dollars in. So that's a lot of cash out of pocket. Say you have a prime plus borrower, everything looks good, he has decent credit, good experience. What can they usually look to be putting down on both the purchase side and on the rehab side?
Yeah, so we look at the deal on a total cost scenario of what your acquisition cost is and what your rehab cost is. And then we would be funding somewhere between 80 to 85% of that total cost, meaning you'd have to come in with 20 to 15% down. Now, pre-COVID, we were going up to even 90.
Mhm.
I'm sure we'll get back to those days at some point, but we're not there right now. So 15 to 20% of the total cost is what you can expect for somebody that's got some experience and some a good track record.
And then as far as ratio to, let's say, total ARV, what's kind of your guys' stop limits as far as how far you'll go up on a deal?
Yeah, it's pretty straightforward, between 60 to 70%.
Okay. And that's
make sure there's
finalized
room and on the back end so that you can get out of it and move forward.
Yeah, absolutely. So, a lot of people that are watching this video and a lot of people that we work with, they always like to utilize hard money lenders. And there's, the space has been getting crowded recently with the amount of cheap money out there funding these hard money lenders.
Sure.
When someone's going to select a hard money lender, what are the decisions that they're going to be facing? What type of things should they be looking for from the hard money lender to just almost like verify or vet that lender?
Yeah, so about 5 years ago, you touched on a point here that it's become a pretty crowded space. Goldman Sachs bought a group out of California, Genesis, and that really legitimized kind of the industry, so to speak. And since then, it's been, like you said, a pretty crowded space and competitive. But when choosing a hard money lender, you really got the option of kind of national versus local, right? So the national guys are all backed by Wall Street. They're typically going to be a lower cost or lowest cost provider typically, but it's still very much check the box even for hard money. You're still going to have to kind of meet their ratios and kind of check the box, as I said. And then you've got local guys that can provide some more flexibility, speed, know-how due to their local knowledge, expertise, and probably just being a little bit more nimble and not as bureaucratic. And then you've probably got another kind of layer of it that is probably just a guy that's got a few $1 million that can kind of write a check on site and take a mortgage on the property. So those are the kind of the three options, I would say. So you've got to kind of balance out how your deal fits into each bucket and what makes sense, and then timing also plays a role into it as well.
Yeah, and I want to touch on a few points you had there. So the first thing is, with those national guys, what I've noticed is the underwriting is very similar to if you were to go to a bank. So the speed is not usually there compared to, say, a local guy. And the underwriting is pretty onerous compared to, say, somebody that knows the local market. The second thing I want to touch on is, again, the importance of going with a local lender that knows the investment areas. Here in Chicago, in the areas that are primarily sought after for investment purposes, a lot of those areas are almost block by block. And someone that is not headquartered in the area that you're investing in may not know that, hey, if you cross the street, all of a sudden the after repaired values jump up 100,000. Or if you go on the other side of this park, then all of a sudden you're in a completely different area, even though on a map it looks like it's right next to it. But if you actually know the local area, you'll start to see those changes. And that's huge for us investors, because we're always trying to invest kind of on the borderlines, right? Where a class A area bleeds into a class B area, so you can buy at class B prices, rehab it, and then sell it at class A prices or C to B, what have you. So those are the two things that I noticed. And then the third thing is, you touched on these what I call these mom and pop hard money lenders, right? It may be just some high net worth individual. It's just him sitting behind a desk and he's just turning his money over and over again. What I've noticed with those types of guys is they usually get tapped out pretty quick, and they could only have a couple loans going at any given time. So if you're relying on someone like that, you can get caught holding the bag with a contract that you're not going to be able to fund. So talk to me about Renovo. Give me an idea of like how you guys are funded and how much available funds you have Every time I've talked to you, you've never had any issues with funding deals. You've never had any issues with finding the money for a property.
Yeah, we've taken a little bit of different approach to kind of the game here, and it's really taking the blend of local expertise and kind of having that community banker understanding and know-how, but kind of cross-pollinating it with an institutional platform and the capital structure behind it. So definitely a little bit unique in that regard, that we have the flexibility of the local guys, but with the backing of the institutional guys.
Yeah. So yeah, I'm glad you kind of covered some of those things. So let's switch gears here, and now let's talk about the borrower themselves or the investor themselves. So, hard money is a great tool if you know how to use it well, but it can be a pretty disastrous tool if you don't know what you're doing. What are some of the most common mistakes you see real estate investors making when it comes to utilizing hard money?
So there's a few I'll touch on here. I would say starting very big in terms of construction budgets, and then maybe municipalities that they're not familiar with. I mean, here in Chicago, you go to Berwyn, some of the other local municipalities, they have different requirements, and they can really jam you up on inspections and stop work orders, et cetera. And if you're not playing by the rules of the game, you can really find yourself tied up with a hard money loan or private money loan that'll just really chew away at your profits. So know your municipalities inside and out. I would say start with a smaller budget, especially out of the gates. Those bigger budgets and those luxury Class A stuff can be very dangerous, because if you don't hit the market time, you could be sitting on that for quite some time and really just getting chewed up, like I said. So budgets and municipalities are the two biggest pitfalls I see.
Yeah, absolutely. And one of the things that I've noticed, especially on the municipality side, is when investors are trying to game the system. So I've seen some pretty nasty deals where the investor tried to avoid pulling permits. The municipality found out, and then all of a sudden they get a stop work order, and now they can't do construction for 6 to 9 months until they remedy this. And that's 6 to 9 months of hard money. That's a lot of interest to be paying. Another thing that I've also seen is the timing of the market, like you alluded to. In Chicago, we have pretty severe winters, and the real estate activity from end buyers, homeowners, drops significantly during the wintertime, and so does prices. You usually see a 5 to a 10% drop in prices across the board during those times. And I've seen some larger projects that the scope kind of exploded a little bit. The construction took a lot longer, and all of a sudden now they're listing in winter as opposed to trying to list early fall, late summer. Yeah. That's caused a lot of issues. So yeah, very, very important things to watch out for. One of the nice things I like about working with you, Brandon, is you're not only a lender, but you're almost like a third-party advisor. You come and you help them with their scope. You tell them, hey, I don't know if this timeline's really making sense. How can we tweak this to make sure that you're geared, because you're always looking to have your clients perform well. The last thing you want to do is take a property, because Renovo's not in the business of owning property. Renovo's in the business of lending capital to successful real estate investors, right?
Yep.
So
yeah, I mean, I work, having, writing hundreds of these deals over my career, kind of seeing, how these deals go and what to expect, and what budgets are appropriate given what their plan is, and also asking if they've rehabbed in places, these different municipalities, to make sure they're aware of all the requirements and which ones are particularly tough. So like you said, we're looking to get in and out of these deals, want to have a successful track record with our guys, and continue to turn the money and help them hit their goals, plain and simple.
Yeah. So one of the things that I've also noticed just because we have buyers that always ask for referrals. And a lot of these buyers are already coming from a previous hard money lender that made some kind of mistake and then have gone over to work with you guys and stayed with you. What are some of those common mistakes you've seen your competitors make, which has caused business to migrate from them over to you guys?
I would say the biggest one, they can lend folks into a problem when they're really, they don't have those conversations. And if they fit the box, so to speak, on paper, maybe it doesn't actually make total sense. And then they can get guys into a couple more projects than they should. And then that creates friction long-term and then an opportunity for us. I would say the other piece is overpromising and under-delivering, especially on timelines. That's a big one. Thinking they can get it done and they can't actually get it done, and for any variety of reasons. And then the third is there's, with the national guys, there's just things that happen on Wall Street or from these institutional players that back them that they might just say, hey, if your budget is more than 50% of your ARV, we can't do it. Or if your purchase price is 50% less than your budget, that's just a hard no. So they start to run into those kind of hard nose in the box type lending scenarios.
Yeah. So we've seen, the market's been really great for real estate, especially even going into COVID. And I think the main reason for that is there's just low inventory. There's just no deals out there. Same thing on the flip side for the homeowners. I'm seeing ARVs going up because of the low inventory. I don't think that's going to last very long. But because of that, I have seen a lot of newer investors jump into the space, start to look to leverage their money and start looking at utilizing hard money. So what's some advice you'd give to, say, a newer real estate investor looking to utilize hard money for the first time?
Let's talk. Let's have a conversation about why we're doing this, and really make sure we're in it for the right reasons. And it's not just a good thing to discuss at a cocktail party, but that you're actually really ready to live and breathe. What this takes to get done. Because fighting with contractors, finding properties, passing inspections isn't for the faint of heart by any stretch of the imagination.
Yeah.
So you really got to have a good team around you to get through it initially. And I think it starts with, a good real estate broker, a good contractor in particular. They can make or break you. And then, from there, if you're willing to, continue to take the next steps and, we've got something to talk about, but a real solid team is what it takes to get you off the ground here.
Okay. So real solid team, that sounds like it's super important. What type of pre-work can an investor start doing to make themselves more attractive as a borrower to, say, Renovo? What things can they be doing with, reserves, with credit, with finances, those types of things?
Well, for the new guys, know your numbers. It's a really disappointing conversation when somebody tells me, hey, I want to get into real estate. And then you start to ask them, what do you look like on paper? What do you make annually? And they say, I don't know. What do you have in the bank? It depends on the day. Those types of answers are just not going to fly well. It really makes the call short, in my opinion. Because if you don't know your numbers, I'm not going to know them either. And you should be looking at us as the lender, as your biggest investor. We're going to be putting up over 80% of the money in some instances. So come prepared and have a good business plan. And you should also be seeking out mentors and folks in the industry that are actually doing these types of deals. And maybe you can start, as an equity investor, putting into their deals so you can shadow them and kind of see how things work. And then the second piece I would say is start to, run a lot of the different scenarios on different deals and track your your neighborhoods and what your business plan can look like, and then start to talk with maybe friends and family on the first deal. So there's a little bit less pressure going into it, and your first deal. So friends and family is a good way to get started. I've also seen people, buy a property and use a 203K loan to get started as their first flip, or buy it conventionally and then fund the construction out of pocket. That's how I did my first flip. So there's a lot of ways to do this if you've got the grit and really want to kind of make it happen.
Yeah. So it sounds like, to summarize, get a good team around you.
Yep.
Make sure you have a solid business plan and you know your markets. Have a little bit of experience before you come to a hard money lender, and then make sure that your numbers are buttoned up. On the financial side, what do you usually like to see as far as reserves? What do you like to see as far as, tax returns, adjusted gross income? What do those types of things look like?
Yeah, so from a liquidity standpoint and cash reserves, that's going to weigh pretty heavily in the conversation, because inevitably during the process of rehabs and construction, there's always something that happens or comes up, and you're going to be expected to step up and typically fund that difference. So we want to see a minimum post after your down payment of a minimum of 6 months of reserves. Okay. Or 50 grand.
Interest? Is that interest reserves only, or is that what types of reserves?
So when I say reserves, 6 months of your like what shows up on your credit report as far as your monthly obligations.
Okay.
So your house, your car, credit cards, whatever it might be, we want to see 6 months of that minimum.
Okay, and then at least maybe $50,000.
Yeah. You're going to need it. The worst thing I can do is lend you into a problem that you can't get out of, and then you're scrambling mid-project to be able to cover any shortfalls, et cetera.
And these are a lot of the things that you cover when somebody first reaches out to you and starts getting started with the process with Renovo, right?
Absolutely.
So tell people then, how can they reach you, and is there anything they should know before they try to contact you?
Pretty straightforward. I got my phone with me, 24/7.
I know
that. But I can be reached at Brandon@Renovo Financial, or also my cell phone, which I can give Fernando to post later. And feel free to either shoot me an email or a text, and we'd be happy to get a call scheduled with you and see how we can make it work.
Great. So Brandon@renovofinancial.com. Yep. And then they can also go to renovofinancial.com. Is there a way, if they go to the website, that they can say, hey, I want to talk to Brandon?
Yeah. So there's if you call in to our the phone number provided online, Jess would be the one that takes the calls in, and she'd be able to direct you guys to me.
All right. Perfect. Well, hey, Brandon, I really appreciate you coming on, taking time out of your busy schedule.
Appreciate you.
I know you have a little baby at home too, taking a lot of your time. So I'm glad you had time to make time here. So appreciate everybody tuning in for this week's episode of What's the Deal, where we covered hard money lending and got you the answers you need. Thank you very much, and I'll see you next week.
All righty.